Freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, here with Adam Penn. Adam, how are you?
Hey, Dustin. Beautiful day here in Northern California. Excited to be here.
Well, I wish I could say the same here. It's rainy and dreary. However, it's my dog's third birthday, so I'm quite excited about that. Gonna have a little birthday shindig for him later today, so I'm pretty...
You get him a chocolate cake?
No, not quite. Unfortunately, my wife wasn't able to find a boy birthday dog treat, so we got him a pink one. We're hoping that it kind of doesn't matter, that since he's colorblind, he shouldn't really care.
Shouldn't change anything except for you guys.
But anyway, well, let's dive into it here. I think we want to talk about markets today. Markets is always very, very important, and we'll kind of go over some things of markets we're currently looking at. And I guess it's important to note this is specific for multifamily, right? There's different markets that are good for different asset classes. We're specifically focused more on the residential side of things. And when I say residential, I mean the multifamily, so not single family homes. But we're not looking at industrial. We're not looking for self-storage. There's different markets that are good for those types of things. But we're looking at markets that are good for rental housing, for people to live in, provide a clean, safe, affordable place for people to live. So no, we can dive into this. And I think the thing I'm curious to start with is your thoughts, because you live in California. Congratulations. And you deal with everything. You get wonderful, beautiful weather and amazing natural resources, and everything else is crap. So a few years ago, you started moving all of your investment and looking to invest outside of California. And I think that's a really good place to start about like what led you to do that and what you've been looking for when you're looking outside of California.
Yeah, I think part of what we were searching for was yield, right? I mean, things are expensive here in California, and I'm not in an expensive area. Average price of a home in my town is $450,000-ish. And, that's expensive for some markets, but not for California. But we're still not seeing the yield that we were able to do, or really almost the diversity, right? But we weren't able to have 4-unit buildings for $400,000, right? That would be $1 million. So I was able to, the first thing we bought in Memphis was $400,000, and it was 4 units. So not only did we get more units, so we were able to have a bit larger tenant base and less risk of vacancy, but we were also able to have a building that was just larger in general, right? From the same amount of money down, right? We weren't having to spend $300,000 down. We were able to do $100,000 down. And so just being able to change that. And then also there's benefits and drawbacks to being out of state, right? If it's not where you live, you can't drive by and check on it and fix the toilet when it's broken and all those things. But on the bright side, you don't have to drive by and check on it and fix the toilet when it's broken. You just have to call someone to deal with it. So those are kind of the two sides of the coin that led me to looking out of state, was really how far did my dollar go? And then yield at the end of the day, which is kind of tied to that original one.
I think to put some more concrete numbers to the idea you're talking about there, right, is like if you have 2 buildings, both are identical, right, and the cash flow, let's say $10,000 a year, use simple numbers here, and you pay $500,000 for one and you pay $1 million for the other, well, the cash flow is the same, right, but your yield, which is what you're talking about, you're searching for, is significantly higher. It's double on the building that you paid $500,000 for. And so I think that's really what you're talking about when you're saying you're searching for yield, you're trying to make your dollar go further, is for the same amount of cash flow, you want to minimize the amount of that initial purchase.
Yep.
And then you made a really good point too, I think, about, and this is big, I think, if you've got people who've used to doing a lot on their own, whether it's in multifamily or single family, right? Like there's, in some ways, it can be detrimental to own something that's close by, where if you need to go solve the problem, you can. Because then I think more often than not, you end up not building a team to solve those problems.
I talked to someone the other day that has 2,000 doors, and they were in another town visiting a friend, and they were at a conference, they had breakfast or whatever, and the guy said, I've got a water leak at a building, you want to come with me? And he's like, yeah, sure, whatever, I'll drive with you. So I hop in the truck and I go over there, and the guy's on the phone and pulling carpet out of the unit and calling people, and he's like, wouldn't your property manager deal with this? He's like, yeah, but not till Monday. And it was Saturday or something. And my buddy was thinking, well, I just would see this 30 days in the rear on a P&L and know that a unit flooded, right? And not had to have dealt with any of it. Whereas you're trying to save 2 extra days, and now you are on a Saturday tearing carpet out of a unit and dealing with contractors when you already pay a property manager to do all that.
Yeah, and I think that's the piece when people talk about real estate's not being passive, that's the sort of thing that comes to mind. And in order for it to be passive, you have to have that team in place. You've got to have that person that you can call in that situation if that work absolutely has to get done right then and there. And being out of state or being further away, being at a point where you can't just drive over to it and fix the problem, it forces that issue. Or it forces, not the issue, but it forces you to solve that problem. So I think that's, for most of the passive investors in syndications, that's obviously not a concern, right? That is a completely passive investment. But I think that's something that in real estate, we talked previously about how important it is to build a team, that real estate is a team game, regardless of the level you're playing at. I think that's a great example. One of the things you didn't mention about California was just, you mentioned the yield and pricing and things like that. What about from a landlord point of view and it being more favorable, or I guess California not being as favorable to landlords and other states being more? Was that a factor in consideration?
So honestly, it wasn't a huge factor for me, just because all of my portfolio in California is short-term rentals. So we're not subject to a lot of those, but growing that portfolio and buying apartment buildings like we're doing now, that's not something I would look for in California. We've talked a little bit about if, a deal pops up in the town that I live in and we have all these connections here, it might be worth taking down just because we are tertiary market, we're college town, we've got good rental history, we've got a lot of connections here with brokers and other things, but overall it is harder to deal with the regulation environment here. So in general, we look for more landlord-friendly states like Vegas or like Nevada and Tennessee, and even Oregon, for it being less landlord-friendly, is still more landlord-friendly than California. It's just mini California over there.
No, and that's a good segue into that, right? Is like, even you've got states that can be good, but there's portions of states that can be better or worse than others. I think a really good example of kind of the opposite direction close to me is just on the other side of the mountain here. We've got North Carolina. North Carolina is generally considered to be a fairly landlord-friendly state, but there's a handful of counties. Buncombe County, the home of Asheville, is a very not landlord-friendly county. And so that just starts to get in the conversation down to like how hyper-local real estate is, right? So even within a given state, you need to be aware of the implications of that, the county, the town, anything else that's
you can get even more specific into a city. If you have a historic zone or a historic building, you might not be able to renovate that one.
Yep, completely true. I've seen some folks even here in my little hometown that have run into that, not having to deal with historic regulations, and then that is good and bad, but it prohibits development, and if you don't know about that going into it, it can rain on your parade. Well, you mentioned Vegas, and I think that's kind of maybe segue into some markets that we're looking at. I'm excited about Vegas. I think we sort of started looking into this because our friend and mentor and advisor, Ken McElroy, is looking into Vegas very heavily. And I don't know that it was something that was on our radar, at least initially, but after we sort of heard him talk about it and some of the benefits, I realized there's probably a decent opportunity here. Do you want to speak more to it, or do you want me to go through our...
Yeah, maybe just super high level. Vegas has got a handful of things that we look for, right? It's both got good regulations around landlord friendliness. It's got good regulations around living there, right? A lot of net migration from California because no income tax, just general friendlier. If you're pro 2A, then it's a lot easier to own guns in Vegas than it is in LA. So, a handful of reasons to kind of move to Vegas, but also then on the supply and demand side, there is very few units getting built, right? It's not one of the larger cities. I think we were looking at, what was it? Did you say it was a Wall Street Journal article earlier that had mentioned that both Nashville and Austin are two of the cities that probably won't have as quickly as recovering rental growth just because they were so drastically overbuilt.
Yeah, and I think that last point is kind of the secret sauce to Vegas. I think that's we can certainly find other markets where there's net in-migration, there's jobs, there's growth drivers, which obviously you certainly want to have in any real estate market. But Vegas is kind of unique in that I think it's probably the largest market. Like if you look at the top large markets in the country, it's had the least amount of new development. And so I think our overall thesis specifically for multifamily is that we've obviously had a lot of units that have come online in the last few years. That has an increase in supply has led to in some instances, a drop. In most places, it's been flat. Rents have just been flat, which is a very interesting thing that given how a historic amount of new apartments have come online in the last few years and rents have not really dipped, which I think is telling for the overall level of demand for rental housing. And I think that's a separate point in and of itself. But with the idea being that we've had no new construction projects have really started in the last 3 years. Once interest rates started going up, it killed the viability of a lot of those projects, and developers just stopped developing because they couldn't do it profitably. And so the things that the new apartments we're seeing come online right now are projects that started 2 to 3 years ago, maybe even longer, because there's nothing new behind that. When that pipeline finally dries up, then all of a sudden this new supply that has been suppressing rents is gone, and yet the demand is still there. And so,
and it takes you years for that pipeline to start back up again, right?
That's exactly right. And so basic supply and demand says when you've got the same or increasing demand but no increasing supply, you're going to have rents go up. So the way that this applies specifically to Vegas is that with it having a very low amount of new supply coming online, it's poised to benefit much faster and in a much larger amount from future rent growth, because you still have people moving there, you still have jobs, there's some other things we can talk about with Vegas and the jobs, and it's not as concentrated in the entertainment industry as it used to be. So there's still all these growth for the city, and yet now there's not going to be new apartments coming online. So that can increase in demand with no extra supply will just force rents to go up, values are going to go up. And that's our overall thesis for multifamily in general, but why we specifically like Vegas and what the Vegas secret sauce is.
Yeah, do you want to talk a little bit about what we've seen in Vegas from some of the deals we looked at, how we're still seeing some people overpay, especially maybe some of the institutional buyers that are family offices? Maybe they're willing to take a lower yield because they're willing to underwrite a little more aggressively. Maybe they see that massive rent growth coming.
Yeah, the market's been interesting. I think it kind of reflects the rest of the country in that it's been slow, but there have been more things coming online. I think there's a couple of, I'll say, challenges or headwinds for us. One is the size that we're trying to play in that makes sense for what we want to bring our investors. Vegas is kind of bifurcated in massive 200, 300, 400 unit complexes that are just huge, and then a bunch of 20 and fewer units.
Lower, like 10.
Yeah. And there's a ton of those. So you can find a lot of that size inventory in Vegas. On the top end, those large properties attract a lot of institutional capital, whether that's large insurance companies, family offices. They like to go after that. And that's not really the space that we want to play in because there's a lot of competition there. On the other end, it's challenging to get good unit economics for putting a deal together for our investors that it's large enough for it to really make sense. And so there are properties that fit in that sweet spot. We've offered on several over the last couple of months, and it's just there's not a ton of it. So for one for us is finding those properties. That's a big one. And then I forgot the second part of your question.
Second part of my question was just, some people are willing to overpay a little bit on them because they're willing to take maybe a lower yield. They're not splitting that.
Yeah, we've seen that from deals that are on the larger side that we've looked at, that we've offered at. Again, part of the challenge of playing in the larger space is that you're competing with folks who they've got different capital needs, and especially family offices. Family office capital is very patient capital, and no investor left behind here. For anyone, if you're not familiar with a family office, that's usually a wealthy person or wealthy family who has effectively an investment arm that manages their money. And so we're usually talking several hundred million or billions of dollars that it's essentially a private hedge fund that they are responsible for. Well, that capital is not necessarily looking for a very quick return, right? That's not the capital that's looking for the standard value add multifamily, double your money in 5 years, 2x equity multiple kind of thing. They're willing to be patient.
If they want to double their money, they'll go into venture capital if they want. Their real estate is to preserve millions.
That's exactly right. They play in real estate for almost purely for the wealth preservation and then any yield they can get on that. And so we've been seeing a lot of that, right? We got beat out on a deal that we really, really liked by a family office who paid, if you look at the cap rate doesn't make any sense, right? That market cap rate was closer to the 6s and they paid in the low to mid 4s.
High 4s.
Just craziness, right? But at the same time, they have different capital needs than we do, or their capital has different needs than our capital does. And so, yes, we can say that they overpaid, but at the same time, it probably makes a lot of sense for their investment objectives. And so, again, speaking to some of the challenges and the overall markets that we like to be in, we don't like having to compete against that. And so that's a bit of a downside to a major market like Las Vegas, is it does attract that institutional level of capital that then on the larger projects, the ones that honestly make a lot more sense for us to bring to our investors, those projects from where simply the scale makes sense, we end up having to compete against folks who have not necessarily deeper pockets, but just different requirements for the capital that they're investing, and they can just inherently pay more. So it can make it challenging to close deals in those types of markets.
So, I mean, that's a big reason of why we're looking in some more tertiary markets, right? Because the larger institutional type investors, hedge funds and insurance funds, they don't invest in some smaller markets, not necessarily because they're not good, but they just can't get the deal flow. They can't underwrite all of them. They're more interested in being in those primary markets. You want to talk a little bit about maybe why we're comfortable going into those markets and some of the ones that we're looking at?
Yeah, absolutely. I mean, that's the primary markets get all the headlines, right? Like they have the flashy things. It's what you see on the graphs. But the tertiary markets are good. We like them. There's places that can typically fly under the radar that still have job growth, rent growth, a lot of economics drivers behind them. And yet they're completely off the radar of that more institutional, deeper pocketed, able to overpay capital. And so it really makes a good spot for the folks that are doing the deals that we like to do, that we like to bring to our investors. It makes for a much better location for finding those. Again, the challenge is a smaller market. There's less inventory. So typically what folks like us are doing is instead of just looking at one market and trying to get all of our deal flow from there, we're looking at several to be able to provide deal flow, but still meet sort of the same criteria that are going to be able to provide our investors the returns that we're looking for. And so we can dive into some of the other markets we're looking at. A recent addition for us is Reno. What is it? What's Reno's motto? The biggest little city in the world?
Yeah, I think so. Yeah, and it's it's close to Tahoe. It's one I've actually been looking at for over a year now. I talked to some brokers a while back, but most of our attention went to the deals we were making offers on in Vegas. But I think now that we really are turning into a new year, we know what the administration is going to look like. I think there's a higher likelihood of seeing more deal flow, or at least being able to more reasonably predict what the next 4 years are going to look like. Yeah,
for sure. And I mean, you talked a little bit about its proximity to Tahoe, but there's some major jobs there, right? I mean, this is something, until we started looking into this, I had always heard of Tesla's Gigafactory, Nevada, and I just naively assumed that it was not in Reno. I didn't know that was there, right? So there's a couple other major
I think Panasonic has a big battery factory there too. I think it's paired with Tesla's, and then there's a lot of automotive industry. I believe Snap-on's got a big maybe not a headquarter there, but a manufacturing area there. And then it's just a lot of other industries. Obviously, there's the tourism and the hotels and whatnot, but it's a good place for net in-migration. Once again, similar to Vegas, people are coming right across the border from San Francisco and whatnot into Reno and into Nevada just because it's more affordable.
Yeah. I like Reno too because there's been a ton of emphasis on Sunbelt markets, right? And that's where there's, especially the last 2 to 3 years, for good reason, not that it's bad, but the Sunbelt has had a lot of focus. And I think Reno's one of those markets that's really flying under the radar for a lot of people. And I'm excited about us digging in more there just to be able to find some hidden gems to be able to bring to investors. And speaking of Sunbelt, some other markets, I live in East Tennessee and have been looking here for quite a while, offered on several properties. Got, especially through 2021 and early 2022, got outbid on basically everything because people were making very stupid decisions. But the market here is great. We've had a ton of in-migration. We're still getting a lot of it. COVID accelerated a lot of things. We get people coming from California, New York, Illinois, call them the political refugees a lot of times is what they end up considering themselves. But a trend that's been going on for a while and is not showing any sign of letting up is halfbacks, which are generally folks who have spent most of their life in New York or somewhere in the Northeast. They move to Florida. They spend a summer in Florida and realize, well, this kind of sucks. And they decide they want to move somewhere a little bit more temperate. And so they move to East Tennessee, Western North Carolina, Northern Georgia, this area, because it's kind of like halfway back to New York. So you can kind of get a better quality of life, lower expenses, but not have to deal with everything that comes with the downsides that come to living in Florida. But we've got good schools here. Knoxville had, for a couple of years coming out of COVID, was always topped one of the markets for the highest level of rent growth. I like to joke about some folks, making these aggressive rent growth assumptions and modeling 10% rent growth. Well, Knoxville actually had that for a couple of years, which was kind of wild to think about. So really like that. And I mentioned just across the mountain, we're not looking to invest in Asheville, but just kind of adjacent to Asheville is the Piedmont area of South Carolina, which is the Greenville-Spartanburg area, another area that has had a decent amount of focus. There's been a lot of in-migration there, an area that I've spent a lot of time, got friends that live there. Outside of investing, if you've never been to downtown Greenville, South Carolina, I highly encourage you to pack up, take a trip, spend a long weekend there, go do some performance driving at the BMW Center that's in Spartanburg and have a fun time. But that's another market that we like, again, for the same reason. A lot of net in-migration, good jobs, employers moving there, employers that have been there for a while that are very stable, and areas that typically are flying under the radar of the more institutional capital.
Anything else that you want to touch on before we kind of close out this episode around markets and the ones we're looking at and kind of the reason we're looking at them?
No, I think this is, there's obviously, we're keeping our eyes open. I think these are some things that are top of the radar where we're spending more time looking for deals right now. But what I mentioned earlier, playing in the tertiary market space in order to just get the deal flow, it's a matter of having multiple markets as opposed to just one. And so, we're always on the hunt. We're looking at economic trends, seeing where people are moving, what's going on with jobs, changes in the political environment, to kind of determine whether or not we should be looking somewhere else or if we should actually stop looking somewhere that we currently are. So it's always this is where our focus is right now, but it's always an evolving thing.
Makes sense.
Yeah, that's all we've got here on market selection. Adam, always good to chat with you about all this stuff. And everyone, we'll see you next week here on the Wealth Independence Podcast. And just remember, where freedom leads, real wealth follows. Thanks, everybody.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.